Your account balance in your 401k is not necessarily what you get to spend in retirement. They have a silent partner, and what you see is not what you get.
You could get a 30% raise right now. Who would not want to take that?
We want our money to be liquid, we want it to be safe, and we also want it to be tax advantaged. Money in my pocket, not necessarily Uncle Sam's pocket.
Are we talking thousands only or hundreds of thousands?
I'm talking literally 20 to 40x. We do that on a daily basis.
The definition of leverage is getting more for less. Only people that go to the bank and take out money without putting in deposits are bank robbers.
Put in $50 and take out $1 million tomorrow. That's not how it works. You need time for compounding interest.
Welcome everybody. We're back here. We are going to be doing our podcast series today, the What Would I Do If ... And with me today is one of our top agents and part of our Valoram Solutions Acceleration Group, Mr. John Mall. We're here, great studios here in Southern California, sunny Southern California, actually. We just had an earthquake today, and we're hoping that this video is going to create an earthquake in your financial situation and shake things up for the better. Please pay attention to some of the concepts that we're going over today. Hopefully, we're going to go over any objections that are in your mind so that when you go ahead and seek counsel with one of our Valoram Solutions advocates, you'll be able to ask proper questions, get right answers so that you can be the tip of the spear, taking territory for your financial future. Excited for you. Let's get this thing started, John, will we? Yep.
Yeah, absolutely. Blessed and honored to be here.
Awesome. All right, John, the number one thing that people are always asking me really is all about what would I do if, and here's the big one, if I had $500 a month, right? That's kind of the midpoint. I'm going to ask John here to go over these details because the key thing is 500 is a lot when it comes to compounding over time. And as we always say, it's better to start early than late. So John, take it away. Let's give three major points, like what would be the top three things that you would do, whether it be a certain product, a certain program, a certain goal, to utilize $500 a month for growing families that are out here wanting to learn.
Yeah, if I had $500 a month and I didn't know where to start or what to do with it, I would look at three main categories. I really want access to that money. We call that liquidity. I want that money to be safe. I don't want to lose that money. I want it to grow for me over time, and I want it to be tax favored. That means money in my pocket, not necessarily Uncle Sam's pocket. So we want our money to be liquid, we want it to be safe, and we also want it to be tax advantaged. Access it tax advantaged, passed on to our next generation tax advantage, and also used in everyday life tax advantaged.
When you say tax advantage, John, let's expand a little bit about that. Right now, people maybe don't know when they save for their retirement in, let's say, their 401ks or whatnot, what happens to that money when they're getting ready to retire?
Well, unfortunately, with your 401k, it can be a great vehicle if you're in the accumulation phase, if you're in the working phase, right? But what a lot of people do not realize, a lot of pre-retirees and retirees don't realize is that they have a silent partner, and what you see is not what you get.
Yep.
Your account balance in your 401k is not necessarily what you get to spend in retirement. Sometimes if taxes are taken, when taxes are taken out of your 401k, maybe that's at a known rate today if you're retiring today. Maybe that's at an unknown rate in the future based on everything that's going on with legislation today.
So they're going to have to pay taxes for sure.
Absolutely.
So the key thing is, how do we eliminate taxes? We always talk about, hey, if you could get a 30% raise right now, who would not want to take that? The question is, how do you absolutely do that? So let's take it back just 1 second on what would I do with $500, right? We're going to put $500 a month into an account. What are the options that people have right now? And let's talk about that real quick.
Yeah, the best way that I could put it simply is that there's different institutions with that $500 a month. You could put that money in the bank, and we know that that money is liquid, it's safe, but it's probably not working for us in regards to keeping up with inflation.
You're right.
Most people put their money then in Wall Street, and those are variable accounts, which go up. They also go down. Both are good things that can be an opportunity when the markets go down to buy more shares and to dollar cost average. Right. And then there's a third thing that most people are not aware of, which is moderate growth, 4 to 8% or so, tax deferred, as well as tax advantaged, safe growth. So we call that money in the bank, that blue money, we call money in Wall Street red money. But a lot of clients that we talk to really want more of that green money, that 4 to 8%, that moderate growth, tax deferred and tax advantaged.
Give me the green, baby. Give me the green,
That's
right?
That's right. And so we ask a lot of our clients, well, which bucket is the best to place that $500 a month? That red bucket, that blue bucket or that green bucket? Well, it's kind of a trick question because you should really have money in all three of those buckets.
Exactly. It should be an and conversation, not an or.
That's right.
But tell people, when you put your money in your green bucket, what are three things that they're going to get that maybe those other buckets will not provide for them?
When you have money in that green bucket, as we talked about earlier, those three big things: liquidity and access when you need it the most, safety in regards to not going backwards in those accounts, as well as tax advantage. Because whether you realize it or not, taxes are going to be your biggest bill now as well as later.
And so now, I know that there's two ways that we can do that, right? I know there's a Roth IRA that everybody wants to learn about. Many people, I've been doing this for over 15 years. They still don't know the difference between traditional and Roth. So let's talk a little bit about the Roth IRA side. And then let's talk a little bit about some of these newer, not your dad's Oldsmobile kind of scenario where this is the new advantage, even insurance plans, advantage leverage plans, as we call them, right? There's all different kinds of ways. We're not going to talk really about the specific product, but we're going to talk more about what they do. Let's talk about the two differences between those.
Yeah. So any vehicles with the word Roth in front of it, we know that grows tax-free. You can access that tax-free, and it transfers to your beneficiaries, whether that's your kids, your spouse, tax-free. So when it comes to a Roth IRA, you can for sure put in a certain amount of money before the age of 50, $7,000 a year. You can put in $8,000 a year after the age of 50. We know that those have management fees. The gains go up and they go down. And God forbid, if I were to pass away today and I had 10 grand in my Roth IRA, my 2.5-year-old daughter, she would get that 10 grand in that account balance in that Roth IRA.
And so by the converse, we've got this newer account, right? These new accounts that everybody on TikTok, everybody on Instagram's talking about. Let's talk a little bit about that. There are definitely some benefits to that, but there's also some pitfalls if you don't structure these things properly or get the right consultation. Let's speak to that a little bit.
Absolutely. So all of the plans that we put in place for our clients are strategy focused and solution focused. They're not necessarily product focused. So when it comes to secure compounding interest accounts, we know that wealth is created with leverage. And a lot of times we can create leverage with these accounts, right? So if you put 500 into a Roth versus 500 into a secure compounding interest account, we know that there are fees in there that are associated with maybe a cost of insurance. We know that that grows with compound interest. We also know that there's also a defensive strategy built into some of these plans if you qualify for it, that God forbid in the event of early sickness or the early death, that $500,000 or 7 figures could be transferred to your beneficiary. So maybe you had 10K in that account and you got terminally ill, or in the event of early death, now your family's not only their house is paid off and protected, but now my 2.5-year-old daughter, God forbid, could have income up to age 18 as she goes through school, past age 18 if she's in college, past age 25 if she decides to go to medical school. So it's not only paying off our debts, but also creating income and a lifestyle. God forbid I wasn't here anymore.
All right, wait a minute. Let me get this straight. What you're saying is a Roth is a great way to save tax advantaged. A Roth is a great way to grow tax advantaged. But in these specialized accounts that we're talking about right now, the professionals like you and I put together for these different clients, not only do they have the tax advantage, but should something happen, that second thing is the leveraged return. So we're saying if somebody passes away, boom, there's money, like tremendous amount. Are we talking 2 times, 3 times? Are we talking, like if I put in $500 tomorrow and something were to happen to me, let's say I'm 45 years old, are we talking like thousands only or hundreds of thousands?
I'm talking literally 20 to 40x. We do that on a daily basis.
Wow.
20 to 40x.
Wow, guys. So remember, leverage, the definition of leverage is getting more for less. Getting more for less. And let me tell you something. As a poor immigrant that came here from the Philippines, lived in 8 of us in a 1-bedroom apartment till I was like 5 years old, I want you to understand the only way to succeed in this country is to have leverage. The most important way to have leverage is in your finances, and the best way to have leverage in your finances is to have a leveraged account. And John here is talking about that. You're talking about 20x, even sometimes 100x. You're not hearing this incorrectly. If you got, John, are we talking about if you got sick? Yes or no?
Yes.
If you got injured, yes or no?
Yes.
If you passed away, yes or no?
Third, yes.
Wow. If you're terminal, yes or no?
Yeah.
Man, I mean, it's almost a yes or chronic illness. You're in and out of the hospital constantly. Can't take care of yourself.
I mean, when iPhones came out 20 years ago, they're a lot different today than they are back then, and so are financial products and services.
Wow. So leverage upon leverage upon leverage, guys, that's the name of the game. So if you're listening to this, what would I do if I had $500? Let's wrap this thing up. It's like I would make sure that I have the most leverage that I possibly could get. I would have a tax-free account to make sure that it's growing tax-free. I can spend it tax-free. It has leverage in case I get sick, injured, or disabled. And then at the end, man, it's going to leave a legacy to my family. Those are these accounts that we're talking about. That's probably why you're here, because you're wanting to learn. And I'm telling you, the best way to do this is to make sure you meet with one of our financial advocates so that they can get together with you and see not only do you qualify, how much do you qualify for, and what is the true nature of what you're going to receive down the road. Now, John, sometimes people say these things could be too good to be true. So in this next section, we're going to just tackle I'm going to hit you with some objections, right? The people say, here's my objections. So first objection people say is this. It just sounds too good to be true that I could get all of these benefits. Let's just speak on one or two reasons why it's not too good to be true.
Yeah, and we hear that on a daily basis and a weekly basis. And I usually say, there's pros and cons to everything. And there's absolutely cons to these type of plans. And the three big ones I can think of is you need money to put into these plans, okay?
That's
First and foremost, you can't put in $50 and take out $1 million tomorrow. That's not how it works.
So let's crush this first one right here, right? You hear it on TikTok all the time. Let me open up my LLC. Let me put my $500 in, and then I want to take my death benefit out. So that's absolutely a fallacy.
That is correct. That is a fallacy.
That is a myth busted right there, guys. Guys, only people that go to the bank and take out money without putting in deposits are bank robbers, okay? So that doesn't work here, okay? So great. What is the second thing?
The second thing is you need time for compounding interest. My daughter's 2.5 years old, like I referenced earlier. I think about her all the time. I talk about her all the time. By the time she's 18, she's expected to have about $1.8 million. She can get away with putting away less because she has more time than I do. She has more time than Alvin does, right? Now, we didn't come from a rich family, but we believe a rich family can come from us.
Yes.
I'm not going to tell my daughter this. Maybe I hope you guys don't show her this until she's later in her 20s, this video. But we plan to teach her the value of hard work, money, respect, etc. But we have resources and leverages and ways that we can leverage building financial freedom for her early on with less because she has more time with compounding interest.
So number 2, John, just so I can repeat this for everybody. Number 2 is you got to give it time. All right, anything that's going to get better is going to take time. Compounding interest. The key word is seed time and harvest, right? Seed time and harvest. You got to put it in. You got to take time, let it grow, and then harvest it at the given time. We're going to have a special series, too, that we're going to go about. It's like, Investor A and Investor B. Look out for that. One of our videos, probably somewhere around here, you can click Investor A, Investor B. What happens if you start 10 years later versus if you start 10 years earlier? Putting in the same amount, you will see a drastic difference. So that's number 2, seed time and harvest. What's number 3?
The last and final third con or downside to any of these type of plans is you have to be healthy to qualify. True story, 12 years ago, my dad actually had brain surgery. My dad wishes he had some plans like this, some leveraged accounts. He can't even qualify for them today. He wants more of these plans in his financial portfolio today, okay? So he's doing fine, thank God, but you do have to be healthy to qualify for these type of plans. As long as they're funded properly and structured properly, meet with a financial professional like one of us who is a trusted professional, has all your needs in mind, that can serve you, right? Does a holistic FNA, we call it, a financial needs analysis. It's got to be funded and structured properly. So number 1, you need money to grow and compound. Number 2, you need time. And number 3, you have to be healthy to qualify for these type of plans. They are not easily accessible to just anybody. About 30% of all of our clients that apply for these plans do not qualify, unfortunately, for unforeseen circumstances out of our control.
There you go. First objection, first myth busted, okay? Let's talk a little bit about this too. It's like, well, why would I put my money in this type of plan versus just what everybody else says, buy term, invest the difference, right? So why would I go with this permanent program that has cash value, this, like we said, the compounding interest account versus, hey, I'm just going to buy term and invest the difference into some quote unquote account. Let's talk a little bit about that.
Yeah, and I love that question. And if there's a difference between theory and reality, and the reality we're seeing is that 61% of Americans are in credit card debt above $1,000. 75% of Americans over the age of 65 will trigger a long-term care event, okay, which can cost in the state of California anywhere from $12,000 to $15,000 a month. What does that mean? That means that even if I have that $1 million 401k nest egg in my retirement, if I get sick and spend $10K a month in 10 years, not only is my retirement depleted, I have no more money to spend on my medical care. Okay. So what we're seeing in the marketplace is that plan is just not working. Retirees and Americans are not on track to that $1 million of retirement. And so things are getting more expensive with inflation, with taxes. People need leveraged accounts more than ever today, just because they're not on track to being self-insured, if you will.
So what I'm hearing from you is the buy term and invest the difference. There's sometimes probably not going to be any difference. That's why you have to have it in a combined account these days, because it does more than one thing at the same time. Hence the word, guys, leverage, right? Keep remembering this. Do less, do more with less. Do more with less. That's the key to leverage. You don't want to do the reverse. We get less for more. Okay, get less for more. And that's what we find sometimes. Now, John, a lot of people always ask, what's better, a term policy or a permanent policy that has cash value in it? You know, they always want to think or. Can you speak on that? Because we always think and, right?
I love that question. It's really an and a supplement. Should you rent an apartment or should you buy a house? I mean, before we bought a house and my wife and I were homeowners, we rented an apartment because we didn't necessarily have the cash flow to afford a mortgage. And in a similar concept, when you're on the younger side, your liabilities are typically higher and your assets are lower. And when you go through the working phase, you're supposed to build and grow more assets and have less liabilities. Right? So in the same way, term has its place in regards to you pay the small bill and your insurance company pays the big bill. But what we're finding is that when that expires, either the coverage gets very, very high and is unaffordable, or you're uninsurable. And people want to pass down a legacy and have generational wealth. So it's not necessarily about needs, but maybe it's about wants also. Should you have a temporary policy or a permanent? You should probably have both if your cash flow allows for it. Should you have an apartment and a house? Now, I don't know anybody that is a homeowner and also rents an apartment, but at the same time, usually the homeowners own the apartment building as well. So it's the matter of wants versus needs and a matter of and versus or.
Exactly. So what you're saying to me, you're saying that everyone over here is that if a proper needs analysis is created, then we're usually going to find that more tools, more products is better than less. Because can we agree that the standalone product probably won't do everything they need? The term product won't do everything they need. And usually, can you agree with me that usually people who are all about term only sell term? And people that are all about permanent only sell permanent. And it's awesome. We are agnostic when it comes to products. We are agnostic when it comes to carriers. Guys, we are agnostic when it comes to all of those things. We just do what's best for the client. We have our 5 W's, right? It has to be a win for the client, a win for the agent, win for the agency manager, win for the agency, win for the carrier. If it's a win for everybody, then we do it. You know, we do it. If it's not a win for everybody, right, John? We don't do it.
That's right. That's
we
right.
Just absolutely stand on our ground and we don't do things that are adverse for the client. So that's a great answer for that one. Okay. Let's go into another one that people always talk about. Well, I don't have enough money to buy the permanent one. Should I not start with at least a term policy? Maybe I just wait, the wait word, right? Mm-hmm. What are the reasons why people shouldn't wait?
Well, you know, as we know, and just the reality is that there's no guarantee that I'll be here by Christmas. There's no guarantee that you'll be here by Christmas, Mr. and Mrs. Client. Can we kind of agree that maybe by now, if you're underinsured or not insured at all, that you probably just gotten lucky? Mm-hmm. Because insurance, any type of insurance, is really meant to transfer the risk of loss away from you and your family. And so it's really kind of just like driving the car every day without a seatbelt. And maybe you've done it 10 times, but maybe that 11th time, nobody necessarily cares about the statistics. if or when it happens to your family, a terminal illness, chronic illness, or early death happens to your family and you're not covered, well, this plan is a little bit too expensive. Well, you should see the cost of not having this plan in place.
I mean, between the two of us, we have almost 30 years worth of experience here. Have you ever seen anybody say, in a time of need, I wanted less insurance?
I mean, we've delivered death benefit checks before on many occasions, and the widows usually ask for a bigger check, not a smaller check.
Exactly. We're the only ones. Everybody else is bringing flowers. We're bringing massive checks, and they always want more. Because, guys, the grief of loss is real, but the grief of finances that come with loss is absolutely real. So at least we could do something about that, okay? Let me ask you this question now, John. Let's segue to this one. What would you say to people that are like, well, this is how my dad did it, so I'm going to do it this way. I'm not open to new concepts. Thank you very much for the information. I'm not open to new concepts. Is the scenario that possibly Generation X, or even further than that, the baby boomers, those products and services that they had, are they totally different than the products and services available today?
I mean, my answer to that, simple answer is yes. And my one sentence answer is money is always tied to timing and purpose. And so if dad is giving you advice on an electric vehicle and in his mind, he's only thinking of a Toyota Prius, he probably should be coming out from under the rock and probably doesn't know about the Teslas that are around today. Okay. So financial products and services are always changing and evolving to the needs of the marketplace. And also, Alvin, we're in a very different financial climate than we're at when dad and grandpa were around, right? And so, you know, we've gone through COVID. We've gone through some market downturns in the past 20 years. We're just in a different financial climate when it comes to inflation and being in a hyperinflationary period. We're in a different financial climate when it comes to taxes, when it comes to our national debt being above 40 trillion, when it comes to Medicare and Social Security being an insolvent fund. Back in the 80s, retirees, and my mom, a nurse of 43 years, only relied on her pension. And that might have sufficed back then. But the triple threat is people are retiring with not a lot of pensions around anymore, Social Security, and then personal savings. And the first two are not necessarily in your control. They're in the state and federal control. But personal savings, if you're not where you need to be, that's really what you have the most control over.
And what I'm hearing from you then is, again, times have changed. I love the pension scenario. It's like, to be more exact, it was like 85% of people were living off of pensions. Now it's like 15% of people. And when you have a guaranteed income for life, we call that locking in lifestyle. And you don't have to worry about money coming in. Plus you have the supplemental Social Security. You're good to go.
Yeah, your paycheck versus your playcheck, right?
Exactly. I think what I'm hearing from you is a person who lives with a secure pension, a secure Social Security, coming from a different era. Not that it's disrespectful, not that that we don't need to listen to them, but that their advice is not actually applicable to people's scenarios.
It's not relevant. It's not relevant, unfortunately. Yeah.
And we always talk about it. And I know I hate to say this, but it's like, if you take advice from people who don't understand the question, you're not going to get the answer that you need. You know, like, naturally, I've been an entrepreneur now going on 20 years. My father worked for the state for 37 years. He's never been an entrepreneur. So it's like, I can't take his advice because though I love him, he can't give me advice that's relevant towards my situation. Would you say that that's probably the same thing when people say, hey, my dad said this is better or that's better, and it was 40 years ago when he made those decisions?
Yeah, you know, I mean, the reality is we see a lot of people through different walks of life. The 20-year young folks and the 80 years young folks, and male, female, different shapes and sizes. And yeah, it's just money is tied to timing and purpose, like I said earlier. And
All right, perfect. Let's get to a couple more objections. So you're probably here, you're excited about what you're hearing. A couple of things as far as getting prepared to come to the meeting so that you can make an absolute decision. Some people say, I don't need to bring my spouse. I don't need to bring my beneficiaries. What do you say to that? Why is it important for them to make sure that they're both there if they're husband and wife or whoever is the decision maker? Let's talk about that.
Yeah, I mean, sometimes when you sit with one leg, if I sit with just the wife, you know, the husband typically says, who is this guy coming into our household giving us advice on our finances? I'm the man of the house. when I sit with just the husband, sometimes the wife says, honey, I'm home. I'm managing the kids and the finances. I'm managing the kids and the household, and I get no sick time. I get no PTA. I'm a 24/7 mom, and you always make decisions without me, honey. When it comes to us as licensed advisors, we have seen husbands not know what the wives have put in place, and we have seen wives who have husbands that don't know what's put in place. So the place that we're coming from is both parties need to be there, so you know what you have in place and you know what resources that you have. Because there's typically 3 promises I make to all of my clients. Number 1, if you make more money, less money, please let me know. There are certain things we can do to maximize your financial portfolio. The second thing is we promise you an annual review. Okay, we don't charge for consultations. Right? We don't charge for annual reviews. If you need to get on our calendar before then, you have access to our personal cell phone numbers, our calendars, our assistants. And the third thing is sometimes, the financial gurus say pay off your debt with every single penny that you have. And other financial gurus say have as much debt as possible to build your billionaire, real estate net worth. So it's like, who do I believe? Do I listen to my dad, my rich uncle from church? Who do I take advice from? And we just say our third promise we make to our clients is we have an open door policy. If you hear from a rich uncle at church, somebody gives you advice that you don't necessarily know benefits you, just come to us with your questions. We have an open door policy as our third promise. Just come to us with your questions. Anything you read online, we'll see if it's applicable toward your specific situation, because an 80 years young individual may not have the same advice or may not have the same priorities as that 20 years young individual.
And what I'm hearing from you too is those 3 things, as well as the first parts that you talked about, they can't be decided upon when only one person's in the meeting.
That's right.
Okay, so I know you do this, and I often do this. If I come to a meeting and I know that both have to be there, I just tell them, let's reschedule, right? And so, guys, I want you to make sure if you show up and it just happens to be just you, and just know we're going to reschedule. And because it doesn't serve anybody, right, John?
Yeah. Would you like us to work with estimates or accurate numbers when it comes to your plan?
Exactly. And we need to make sure that all decision makers are there, because I love what you said earlier. You're just lucky. We're lucky that we didn't pass away yet. Lucky that we haven't gotten sick. Lucky that we haven't gotten trouble. I've seen people, tell the story about what happened to your neighbor. Could you share with that? This is really important, guys, to listen to this.
Yeah, just a few weeks ago, on Mother's Day, my neighbor was taking pictures with his wife, had his arm around her, and we noticed that there's 8 ambulances in front of my house. My wife's like, why are there so many ambulances? And, we text my neighbor, female, and she said, please pray for us. So-and-so has passed away in his sleep overnight. We were supposed to have dinner the following week, actually, 52 years young. They have coverage. They have things in place. But we were actually supposed to have dinner. He's in real estate. His wife is a mortgage broker, right? We were actually supposed to have dinner about collaborating in business, actually putting more in place for them as well. And unfortunately, just in his sleep, the Lord took him upstairs. We don't know why, we don't know how, but it just things, those term policies you were talking about, Alvin, earlier, is they work when you die on time. When you don't, but if you pass away by accident, we don't know the reason. We're seeing many young people with illnesses. More and more of our clients, God forbid, are having young children with illnesses. We don't know why, the reason, but it is happening.
Absolutely. And so the key thing is making sure that you're both there so we can make a strategic decision. It's like charging all the way to the 5-yard line and then saying, oh, you know what, we're going to think about it, right? Which leads me to the next question. After we go through all the stuff, and then they say, I want to just think about it. Guys, we want to let you guys know we've trained our team that if we don't place coverage for people that have no coverage or have no plan, have no savings plan, we train them that we have failed. So please don't be insulted if we're going to immediately ask you to get this going if we believe it serves your needs. But when people say they should think about it, what do we really say to them to make sure that they understand that we're not trying to be pushy?
Yeah, it's perfectly fine if you need to think about it. So a lot of times that's just sales resistance, and we really don't even allow you to move forward unless we're at 10 out of 10. Scale of 1 to 10, 10 out of 10 on 3 areas. if we really brought value to you today, where are we on a scale of 1 to 10? Well, we're really at a 5. Well, where are we missing? Where are we lacking? Where's the 5-point deficiency? How can we improve? Was there something we missed? Was there an education piece that there's missing information? Is there an account that's missing that we didn't take account for? Or is it really, maybe you just don't like me or trust me, which is perfectly fine. We're not for everybody, right? And so if you have a goal of $1 million, 8% tax deferred, and you start at age 30, you'll hit that goal with about $300 a month. If you wait about 10 years later and you need to think about it for 10 years, that same $1 million goal is almost like $800 a month.
Wow.
And so we know that people usually think about it or procrastinate, typically because of 3 reasons. Because, I have too many bills right now, or my debt is too high right now, or just YOLO. I really just want to live my life right now. But we just know that it's more difficult the longer that you wait.
So when people say they think about it, number one thing that they want to make sure of that you're saying to is like, hey, if you think about it, if you already intended to do this, and if you think about it, it's just going to get worse as you think about it longer, because it doesn't get cheaper as you get older. And you need to put away more because you have a shorter period of time. That's what I'm hearing from you.
Yeah, because time is either our best ally or our worst enemy. Time is either our worst ally or our best enemy.
Yeah. And so that in itself, you should think about it. But remember, we always talk about, are they really the only people that have to think about this, or is it a two-way street?
Of course not. Well, a lot of the plans that we put in place have guarantees in them, right? And a lot of the plans we have in place, you have to go through something that's called suitability. So it's not only you who has to think about our institutions and our 50 plus carriers that we partner with. It's our 50 plus carriers that have to think about you. Even if you like this plan, and you can't just sign up today and have it tomorrow. You have to go through a qualification process with a lot of the guarantees and promises that we put in place, don't believe me, in writing in our contracts.
So wait a minute. I just want to make sure I'm clear. Just because they want it, they just can't have it immediately.
Don't get mad at me.
Yeah, and that sounds, guys, I'm pragmatic. I'm practical. That sounds like a sales, statement. But truly, the suitability process, as well as the qualification process, one of the reasons why they have suitability, why do they have qualifications for approvals, John?
Yeah, it's actually to protect the consumer, believe it or not, because there are, unethical, immoral, illegal practices out there, especially with the elderly community that we serve so often, right? We need to make sure that you're of a sound mind. You need to make sure that your licensed advisor keeps up with their licenses, that they're licensed to solicit in your state, that they keep up with their continuing education unit. So 1 hour on the front end, how it looks to you, is almost 10 hours on the back end with our back office assistants.
Yep. Guys, back to that point that John's talking about, as far as some people are just fraudulent, some people are just unscrupulous in what they do. I want you guys to understand, people always ask me, right, John, are you guys fiduciary? Do you guys use fiduciary standards when you're tackling my situation? The Valoram Group and Valoram Solutions always takes a fiduciary standpoint, and we want to make sure that we don't lose you money, and we want to make sure that we're putting you in the best practices, best situation that we can put you in. In fact, right, John, 98% of our offerings, they cannot lose money.
That's right.
Right? Guaranteed they cannot lose money.
That's right.
But I want to also make sure we guys understand this, because I would be remiss if we didn't state this to you. And I want to make sure, I'm going out on a limb here, but I want you guys to understand. We take it to a higher standard, which is we're a God-fearing organization. And we just know that I'm not going to sacrifice my future, my heavenly future, by screwing people over. That's why I personally, and John, for sure, with the 30 years experience almost between us, you can look online, because there are places where you can look online to see if we have infractions, if people have complained about us, and I have 0 and John has 0.
So Alvin,
0.
What you're saying is our license number, that's not something that is difficult to find. It's actually public information.
Absolutely.
That you can go on these financial sites and say, is Alvin's 2025 license active? Can you solicit business in my state? There's places online that consumers can actually check on that.
Absolutely. Wow. In every state, you can take a look. And myself, as well as the corporation, and I think John, we're licensed in every single state to do business. So that's 50 states that we could have screwed up, if we had bad practices where people can readily just make a complaint and it will stay on our record, because it's almost in this area, it's not, innocent till proven guilty. It's actually guilty till proven innocent, and the complaint stays on there. So guys, 16 years I've been doing this now. John's over a decade now. You're looking at it and you're sitting here saying, if we were out to do things in the wrong way, there should be some complaints. And we challenge you, defy you to go ahead and take a look. We don't have any. Why? Because we just hold to a higher standard. I'm not telling you that everybody else who's not holding to a godly standard I'm not judging them. I'm just telling you who we are. And I think we'd be remiss if we didn't share with you our beliefs. So for sure, that's the key thing. All right, let's move on to a couple other last questions and we'll go from there. We also have individuals that say, you know what? This all sounds great, but maybe you might be thinking about taking that information that you learned from us and then bringing it to somebody else, maybe an old advisor or always the cousin, and having them utilize our information, trying to implement it. Now, we know, John, that we don't mind. That's no problem, because we're not foolish enough to think we're going to do business with everyone. But tell them, we believe that's actually a mistake, John. Could you share with them why that's a mistake to take our plan of action and have somebody try to implement it?
Yeah, everything is in context. And it actually reminds me of a client. A lot of what we do is what's called tax-free retirement, right? Using Roth conversions. And we actually had one client come to us and actually eliminated all of her liquid savings because her Roth conversion was done incorrectly. So if you take a short YouTube clip, if you take a short Instagram clip and you just try to DIY, I mean, Alvin always says there's two things you shouldn't do on your own. You shouldn't do your surgery by yourself and you shouldn't do your taxes by yourself.
Absolutely.
Right? And so if you take a small piece of information surface level without context, really knowing the pros and cons, because let's just face it, money is just a game. And the more rules of the game you know, the more that you can get ahead of it. But it's important to understand your enemies. And taxes is a big one, to be honest, right? And so she did it incorrectly, and her advisor did it for her incorrectly. She had $72,000 in liquid savings, but she got pushed from the 24% tax bracket to the 37% tax bracket. You may not know what that means, but it means that she just had to pay more in taxes, and it had to come out of her pocket. Well, what if there was a way that there's two things guaranteed in life, death and taxes. But what if there was a way that somebody else could help pay for your tax bill, right? So a lot of the strategies we implement for our clients puts them in the best position and gives them more income, almost 50 to 70% more income by avoiding unnecessary taxes and market loss.
And again, on that same note, taking somebody else's strategy is like taking a playbook from another team and trying to implement it on the fly. I coach basketball. John plays basketball. I coach the kids, and I always tell them you shouldn't practice on game day. And taking somebody else's playbook and going to bring to some other person and say, hey, implement this plan, it's totally unfair on them. And it could be very detrimental to your situation, because taken out of context, plans could be implemented incorrectly. And as John said, it could cost you tens of thousands of dollars in mistakes, that many of those mistakes cannot be reversed, right, John?
Yeah.
So guys, always tell us. We would rather you be honest and say, I really just need information, and I will tell you. Our advisors, we've been trained. If you come to us and be honest and say, guys, I really want just information. I have a person I'm doing business with, blah, blah, blah. We will give you some second opinion information, because we want to do that for you. Now, we're not going to work for free, just like anybody else. I want you guys to understand. You don't work for free. We don't work for free. But we obviously know that we are favored and we are blessed. And if we give of ourselves to other individuals, we're going to be blessed. We're going to be taken care of. So don't worry. Just be honest, right? If that's your intent, be honest with us. We'll take care of you. But if your intent is, I really like your content, we really like what you're doing, then let's do something for you and get you taken care of, okay? Let's wrap this up and let's just go over one last question. So John, let's go through what I call the gauntlet. 35, 45, 55, 65. We're going to do kind of a fast-paced question here. These specialized accounts that we're talking about, it could be all different kinds of products we want to make sure, but the context of it is these specialized products that save taxes, have leverage, all these things. Tell me, 35-year-old person, what is the benefit to them at age 35? Let's take the top 2 benefits. What's the top 2 benefits for them at age 35 to act now and act fast to make sure that they put something like this in place?
I would say you have liquidity in the earlier years before the age of 59 and a half when you may need it. And then your money grows tax-free and you can access that tax-free as well.
I love that. So if maybe you don't know, 401ks and all these qualified accounts, until you're 59 and a half, you cannot access those monies without, how much is the penalty,
without
John?
a 10% federal penalty.
10% plus all the taxes. So what you're saying, John, is at age 35, this could actually be an accessible emergency fund, and it's not locked in. You could kiss that 401k money away once you drop it in there. But here, to start early is because you're not squandering it. You're putting money in there, and you can access it before age 59 and a half.
That's
Guys,
right.
that's huge. Absolutely huge. That's definitely one driving point. Because probably at 35, maybe you don't have kids yet. You don't have a home yet. But now, let's move to the next there. 45. Now they probably got kids. Now they probably got a home. What is the most important things that they need to be thinking of, why this product helped them?
Yeah, well, when it comes to a 45-year-old versus a 35-year-old, they're probably thinking about their health a little bit more. They probably get out of bed a little bit slower today than they did 10 years ago, right? So you want to make sure that things are in place in regards to a foundation. We have your foundation all in place. Usually the people look at the investments, the risk, and the business first. We put your foundations in place first. God forbid if you got sick. God forbid your 401k takes away their match. God forbid you lost your job. You have a private account that now transfers with you that you don't have to transfer every time that you get a job. If you're a teacher, if you're a nurse who have almost 10 different jobs throughout their whole career.
So you're saying that number one, at age 45, you're probably settling in. This is probably your last hoorah for your job going forward. So it's time to go ahead and put money into a plan that's going to be there for you long term. We talked about kids. We talked about homes. Now you have much more liability, many more people depending on you. We talk about a thing called HELV, Human Economic Life Value, John. So let's do that real quick calculation for them. At age 45, that's probably when you should be thinking about that, right? You know what I mean? Could you calculate for them? Let's say I'm 45. I'm going to work till 65, and I make like $100,000 a year. How does one calculate what kind of coverage they would need?
So we're talking about 20 working years times your annual salary. 100,000 is $2 million. God forbid something happens to me today. $2 million is potentially exiting my family's life, my dependent's life, right? That $2 million human life value. Would you like me to give you a little bit more exact number? Sometimes people say, yes, I don't want a $2 million round figure. Well, great. Could you kindly tell me when you're going to pass away? Because then I can give you a more exact number. You know, we joke about it, but it's just like, we just don't know. We just don't know tomorrow.
Right?
Tomorrow's not promised.
And we always ask, hey, if 2 million is the true number, how much of that do you want to leave to your family when and if something happens and you pass away? Does anybody ever say less, John?
I still have yet to find that person.
Okay, I still have yet to find that person as well. Let's take it one last thing. We're going to wrap this up here. Now we're at 55. We're in the red zone. We're about to retire. Some of these people are saying, it's too late for me to get this kind of coverage. It's too late for me to put money in there. Is it ever too late, John? What's the 2 reasons why a 55-year-old might want to do this?
Well, when we're talking about the retirement red zone, we're talking about playing catch up, right? And so if you have less time, we already went over that, you need to put in more. So if you have that 10-year window, maybe $100 a month probably won't get you to where you want to be anyway. Maybe $500 a month maybe won't get you to where you want to be because you have less time. Now people are looking for more guarantees. Our 55-year young individuals are looking for more guaranteed income on the back end. They're looking for more guaranteed growth above inflation. Because if inflation's at 3-4%, I'm saving in the bank at 0.001%. We know that money's not going to double fast enough for us to have a livable wage to live off of. So we need to have more guarantees in this plan. We need to have more tax-free growth in this plan. And we need to have more 6 to 8% growth in this plan or more.
They need to, like, one thing too is like, they need guaranteed stuff. They need stuff that's going to be more secure. And then they could create a secondary pension or a primary pension if they don't have one, right? Our newest product that is proprietary to us, everybody's asking, is it a guaranteed income for life, John?
Yeah, absolutely. It is.
So at
Without a doubt.
55, these people, they want to make sure that they get a paycheck and a playcheck. So that's it. Let's take one last one, 65. Now, these people are retired already. They've exited their work. Now they're like, why would I still want life insurance? Why would I still want a policy like this? Why would I want an advantage? They're probably talking more legacy and stuff. Give us 2 reasons why they should be taking note and doing this.
Well, we've all heard of what's called the 4% rule. 2 simple things very quickly. If I'm 65 years young and I really want to retire with maximum income, we need to find ways to lower your tax bill and to increase your rate of return on distribution. We need to find ways to decrease your tax bill and increase how much you can take out. That means if you have $1 million at 65, you can take out 4%, $40,000 a year pre-tax. That is below the poverty line no matter what state that you live in.
Mm-hmm.
But if you're far behind that nest egg $1 million, we need to find ways to decrease your tax bill and increase how much you can take out. So some of our plans, they can take out 6 to 8% without introducing more risk. Well, what are the other options, Alvin? The other options are maybe you need to work longer because you're just not on track. Maybe you need to cut your lifestyle and eat peanut butter and jelly and ramen, not by choice, but by force because you can't afford to eat anything else, right? Maybe you need to save more money, or maybe you need to die sooner. Wouldn't recommend that one.
Yeah. So what I'm hearing from you, John, is at age 35, this is an emergency plan that's accessible, that grows really well, and it's tax-free. At age 45, this is a thing that now starts to cover your liability in case something were to happen to you because your family really needs it. At age 55, this is a way to create a supplemental pension for somebody, a supplemental income, so that as they lead into it, they could feel better. And at age 65, this is a way to cover many of those needs, maximize income, but also on top of that, we talked about leave a legacy to the family at that point.
Not be a burden to the next generation.
Not be a burden, leave a legacy. And even living benefits, we'll get into next time, but living benefits that allow you to access the money before you pass away, guys. Long story short, whatever the case may be, you're going to be meeting with your financial advocate, one of our financial representatives or professionals that are going to go through your numbers specifically. Pay close attention and make sure that you make a decision, right? Make a decision that's going to help your family because we're looking for progress, not perfection. So this is Alvin Ubaldo and John Mall. We're excited that you've been able to join us. We're excited that we've been able to help you with a little bit of this information. We hope that not only this brought you value, but it allows for you to be prepped up for your next appointment with your financial professional so you can make the greatest decision of your life this year that could lead into the greatest retirement and the greatest legacy that you could leave for your family. John, any last words?
We look forward to connecting with you. Blessed and honored to be here and to be able to introduce resources to create leverage for you.